global activity. These are pictures showing you some of the classic leading indicators that we look at for where things are headed at the global level. If you look at, for example, manufacturing PMI numbers above 50 give you a sense that manufacturers are expecting expansion. And this is a number that has generally been ticking up across the world. And you see similar reflection as well. I mean, this is a prospective measure. You see similar numbers as well in the IP. I think a really fascinating development from our perspective is what's been happening with world trade, though. While we see the signs of prospective recovery in manufacturing and industrial production from individual national economies, world trade has actually been quite stagnant since the global crisis. And there was a bit of a dip, as you can see with the yellowish line there, some recovery since then. But this is something which is a very different dynamic post-crisis. World trade grew much faster than global output in the 20 years ahead of the global financial crisis. Since the global financial crisis, world trade volumes have been quite stagnant. And I don't have an answer as to why this is happening and what the implications necessarily are, but I think for the Asia region, it's a very interesting thing to keep an eye on, because of course this is a region where traditionally exports, integration on the trade side has been very important. And it's something which I know at the IMF we will be trying to dig deeper into. But the basic message out here is that some of the high frequency indicators are pointing upwards, and that does give us some sense that there will be a gradual recovery, at least in parts of the world. And you can see this as well at the country-specific and the regional level. The numbers for the US are looking very good on the PMI side, the left-hand picture there. I'm afraid the numbers in the euro area are a little bit more mixed, and Japan seems to be still a bit of a crossroads. We don't quite know where things are headed there yet. The picture is a little bit more mixed, I would say, on the emerging market front, as you see from the middle panel. And I think the underlying driver out here, and this is something that we've spent a lot of time trying to understand, is that investment recovery remains quite weak in emerging markets, but also globally. And some of the candidate explanations that are being put out as to why the investment recovery globally has been so weak, people point to generalized uncertainty, risk associated with geopolitical events, uncertainty about policy direction. People point to the basic fundamental, basic economics 101 kind of argument that you invest based on the expectation of future sales. And if the expectations of future sales growth are very weak, well, investment is going to be weak as well. And that's actually a model it's a very old model. And it's a view that actually seems to fit the data pretty well these days. So that might just be a reflection of the fact that private sector across the world is still having a pretty mixed picture about where demand and recovery is headed, at least at the global level. So at the start I was telling you about these legacy effects, and I think this is the world in the advanced economies has been through a very large balance sheet recession. Not your typical recession, it's a recession where you have financial crisis, very high levels of leverage, and we've seen historically that in these kind of recessions, the recovery tends to be very weak, very protracted. It takes time for households to adjust their balance sheets. It takes time to deleverage, and this process, the recovery tends to be quite shallow. And you see the divergences though across the US and the euro area with the recovery. I mean, the euro area has not even fully come back to, at least the stressed euro area has not even fully come back to the level of output they had before the crisis. And the euro area as a whole is just about coming back. So the picture at the bottom shows you the gap vis-a-vis the pre-crisis trend. I mean, there are many different ways of doing this. But the basic point is that the balance sheet recovery, the balance sheet recession in the euro area has been much more protracted. The bars are showing you in a sense, the amount of output that has been permanently lost. And the numbers are huge. They're really very large. Now, you can have a very large debate about, why is this the case? Why has the recovery in the United States been quicker? My personal view, and I think this is the view that many would have, is that it's been easier to do the right thing in the United States. It's the formula. I mean, we know what the formula is. You have a problem, you have to deal with it, recapitalize banks, restructure debt, and get on with life. And it's been much harder to do that in the euro area. And this is all taking place at a time where, as I mentioned to you earlier, the picture on the inflation risk and the deflation risk front is not looking particularly good as well. I think this particular chart may not be fully updated, but you will have seen that the latest prints on inflation in the euro area have been quite weak, and having some degree of low inflation for a period of time is not necessarily an issue. The question is that you don't want to see inflation expectations becoming unhinged and moving down permanently to lower levels. And from a central bank perspective, we would argue that central bankers, of course, are very risk averse. We don't want to have risk. And having this situation where you are even at the risk of deflation is quite problematic. And I think it's one of the reasons why the ECB is pressing so hard to be able to introduce a quantitative easing program. And the picture on emerging markets, has been mixed. We've really struggled with trying to explain why emerging market recovery has been surprising on the downside. We've tried global explanations. As I said to you, one of the explanations was this investment story. There's a common factor. Globally, investment has been weak because of global uncertainty, because there's uncertainty about how strong recoveries would be. But frankly, I think at the end of the day, there's so much country-specific factors that are driving investment performance. In India, you had a very weak government that was not being able to advance reform. China is, by design, slowing down investment. Brazil, as I mentioned to you, has been moving sideways for the last 3 years. Very high cost of doing business in Brazil, and no change out there. And Russia, well, what the situation there is. So it's really been a bit of a, I'm afraid the picture here has not been as encouraging as we would like. I think on the flip side of it, of course, is that it's becoming increasingly clear what needs to be done. And it basically is, I think, a back to basics kind of approach of going back to thinking about fundamentals and what you can do to boost productivity, improve business climate. I think that's going to be a key point going forward. So if you look at the factors that are currently supporting the recovery, I feel that in giving this talk to you, I'm constantly trying to balance being very pessimistic with being a little bit more realistic about what the situation is. And I think while from an emerging market perspective, advanced economy, monetary policy has generated side effects in terms of capital flows and exchange rate volatility, the argument that we make, and I think most would agree, is that in general, having had this support has supported demand and growth in these economies, and that's been a good thing from a global perspective. More effective communication of where the monetary policy is heading, of course, would be a good thing to have as well. But the view that we take is that while it's not all about demand as it was maybe 3 or 4 years ago, you still need to have some degree of demand support and and I think you're going to find that the expectation is, we know, of course, that the BOJ is doing massive QE. We expect the ECB will start some QE as well. We don't know how much. There are issues about how much they can do. The US will probably start turning in the opposite direction, but generally conditions will be quite supportive. And the fiscal policy settings also, you may recall back in 2008, 2009, the global community got together and we had this 2% fiscal stimulus agreement, and the G20 countries were doing fiscal stimulus in a coordinated way. Since then, given the high cost of bailing out banks and fixing the financial sector, debt levels have gone up. And I think there's been a lot of political pressure in countries to get their fiscal houses in order, and pressure to do fiscal consolidation. Well, that happened in 2010, 11, 12, 13, and you could debate whether this was something that was timely or not. It subtracted from demand. That adjustment has largely taken place now, certainly in the United States and other countries. More needs to be done, but that subtraction from demand is not going to be as much of a factor, and I think that's something that supports the outlook right now. On the emerging market side, I think the slide says favorable conditions in advanced economies. I think we should just call it what it is. It's favorable conditions in the United States, which is something that would be supportive for emerging markets. I think something that I think would be very interesting to think about, and something we will be thinking a great deal about, is how the unbalanced recovery right now and the resulting exchange rate movements, cross-exchange rate movements, what this particularly might mean is something that we would think a great deal about. So, you couldn't have an IMF presentation on World Economic Outlook without a table with some numbers. I was telling Kunawaraman that I won't be speaking about Thailand specifically today. It's not my place to speak about Thailand, but I'm happy to help try to put things in perspective. We have another team that looks in Thailand. But I would share with you some numbers on the global side. And I think I will leave these numbers to you to peruse at your leisure. The basic message is one that we marked down growth some. There have been large revisions in places like the Euro, large-ish revisions in places like the Euro area. Russia and Brazil are ones to watch. And these are things that I think we will need to be focusing on going forward. Now, I would say one thing though, which is that you see a revision out here on low-income countries as well. Now, speaking before an audience such as yourselves from a large emerging market like Thailand, one tends to focus on emerging market issues. But the low-income country story is an interesting one. We call them now frontier economies. These are large economies in the African region and other parts of the world. And the striking thing is, well, you see these small variations in the numbers. Low-income country growth being marked down from 6.3 to 6.1. Don't forget the overall number though, that's 6%. This is a part of the world that is growing very, very fast. Now we can raise discussions about Ghana and other places and sustainability and all that, but it's been a really striking feature that these frontier economies present opportunities. Our countries that are, after many years, have gotten their macroeconomic houses in order, and we do see upside potential out here for continued rapid growth. I just thought I'd mention that because it's something that typically, we may tend not to think that much about. I can certainly tell you that from the perspective globally, you see countries like China having a very large interest in these parts of the world. Now, I think it's largely a resource play, but it's certainly an interesting perspective to keep in mind. So, as I mentioned to you earlier, we have tended to see downside risks increase. I won't go over the long list out here, but give you some quantification of it as well. Our colleagues in the research department are very fond of drawing these complicated fan charts and diagrams. But the basic message that you get is that the whole balance of risks is tilted down. And they are also very bold. They come up with numbers on the probability of recessions. And there's a good empirical methodology for doing this. It tends to generate very large headlines. When you start saying things like the Euro area has a 40% probability of a recession, that has gone up. But the numbers aside, I think it gives you a very good sense about where we see the weaknesses and pressure points in the global economy. And certainly the Euro area and Japan are very much on our minds. And let me talk to you a little bit about something you may be hearing a great deal about, the so-called secular stagnation. And the basic notion out here is that I've been telling you that we've been consistently surprised about growth. Growth has been weaker than we thought, the recovery has been shallower than we thought, and the reasons are complicated, but we've been getting it wrong now for the last 4 years. And that makes us think that, well, we've got this, the problem globally is a problem of supply. Supply has not been growing as fast as we would like, potential output is weaker than we think. And that suggests to us from a policy perspective the importance of thinking about measures to boost supply. And there's the good old stuff, structural reforms, productivity enhancing reforms, maybe trade. Maybe we need to think much harder about trade as an engine for getting growth going again. We tend to not, trade has been de-emphasized the last 5-10 years. But the secular stagnation point is that this may well be the case, that supply is weaker than we thought and we need to do something about it. But we are in a very perverse state of the world right now where interest rates are at the zero bound, demand remains weak, and the basic notion of the secular stagnation idea is, for those of you who remember your basic economics, you think about an interest rate that creates stability in the system that matches supply and demand properly. The basic notion of secular stagnation is that interest rate, that conditions are so weak globally in terms of demand still because of this balance sheet recession, that the right interest rate would be negative. The problem is we can't deliver that kind of a negative interest rate. You have the zero lower bound. You can't go below zero on policy rates. I mean, you can try, but there are many side effects of that. And so in that kind of a situation where monetary policy looks loose, but it may not be loose enough to get the kind of growth going and recovery and demand going. And so this is an idea that Larry Summers, I think, popped sometime in 2013 at this event in the fund. And we don't know the answer to how much of this is the case. It does, though I think this slide basically shows you a series of scenarios about what the implications could be if this were actually to be the correct diagnosis of what is afflicting us globally. And the implications are bad. It's bad for growth, bad for inflation, and this is, after all, just a scenario at the end of the day. So the implication of this is this, that in the first 3 or 4 years, we were all worried about demand in advanced economies and monetary policy to support it, QE, etc. The pendulum has swung more now towards thinking about supply, potential reforms to get that all fixed. But we shouldn't forget about demand. That's the basic message of this picture. So, this is a picture about China. What it tells you is this, that China is slowing and expected to slow. So as I was telling you, it's our baseline. They will succeed to pull it off and rebalance. The other side of the picture shows you that China has become big. China is quite globally important now. And I think it's going to be a fascinating story to watch China in the next decades. What happens to the RMB, internationalization of the RMB, capital development, all of it here. The next topic is something which is hanging in the background. We'll be talking a little bit about some of the potential implications out there. But there are downsides, and this is something that I will talk to you a little bit about perhaps later in the presentation. And I would say that generally, in the last 10 years, the situation in most emerging markets has improved a great deal. In terms of the usual balances that we look at, current accounts, fiscal balances, inflation, things have improved. But the striking thing to keep in mind is that for some of the larger emerging markets, imbalances have re-emerged. And I haven't put the names out here, but these are places like Brazil, Russia, other regions, Indonesia to some extent as well. Inflation has ticked up above targets, current accounts have widened. These are things that we all know and appreciate in usual challenges, but it's something which I think will bear close watching going forward. So the picture that I've presented to you is one where we have tended to shift down our views on growth, partly reflecting supply side issues, partly reflecting still persisting concerns about demand and secular stagnation, partly reflecting political uncertainty in events, etc., etc. And this has tended to pull down the projections for growth that the fund has been making for the last 2 or 3 years, and this revision downwards as well. The big event that's taken place since then has been oil. Let me spend a few slides now talking to you about our view on oil and what it might mean for global outlook. So, just to give you a bit of a preview about where I'm going. Oil, you'd think, if you just thought about it simply, low oil prices for countries like Thailand should be a good thing, right? That's what you'd expect normally. And that's a view that many would have across countries that are net energy importers, net oil importers. I'd like to argue to you that the picture is a little bit more complicated, and it depends upon how you think about it, what the effects might be. But to start at the beginning about the oil story, I think the first fact is that oil prices have surprised massively on the downside. They moved down a great deal. Nobody saw it coming. You can see on the left-hand picture the futures curves evolution through time. You can see the very large innovation that took place in the futures curve. And I think the question about why oil prices fell to the extent that they did is really a key question, because you need to be able to discuss the implications of the lower oil prices. You need to be able to answer the question about why they fell. And the problem is that it's hard to answer that question. You might say that it's a mix. The usual economics argument would be there's a mix of supply, there's a mix of demand. On the supply side, so is it demand or is it supply? This is a question where I think people will be writing lots of papers and doing lots of in-depth studies, so I'm going to give you a very superficial set of answers right now. The left-hand picture makes the case for it being an issue of demand. This is a series of forecasts from the IEA for global oil demand, and you can clearly see that the outlook has been generally being revised downwards. Of course, that's something which is slow moving. So you'd ask yourself, if this was the view about oil demand, well, why would you have suddenly such a sharp movement in oil prices? It's the sharpness of the movement that's really hard to explain. You might say that, well, the summer of last year, we were revealed new information about weakness in Germany, weakness in the euro area that we hadn't thought about. Maybe that was it. Finally everyone woke up and realized that, guess what? Oil is not well in the euro area, and it's going to be a drag on demand for oil as well. The other factor would be supply. This picture on the right-hand side is a picture showing you various commodity prices. And the point that I'd like to make to you here is that when you have a shock to demand, typically what you would see is co-movement in commodity prices. If there's weaker demand, guess what? You demand less oil, you demand less copper, you demand less metal, you demand less food. This is a different picture, it's a different category. But the general notion is this, that they should tend to move together. And the fact that you've got oil prices moving much more than other commodity prices. And I grant you, I understand that hard metal prices have moved recently. You see copper prices having fallen actually since the renewed concerns about China, etc. But the fact that there's been this very large divergence is to us an indicator of the fact that there's probably a significant supply component. And the supply component that everyone is talking about is OPEC, the Saudi Arabian decision, the signals that are being sent. And there's a whole cottage industry now trying to figure out what is going on with the Saudis and what the game plan is. Some argue very cynically that they are trying to kill shale oil. Some would argue that they just realize that they're no longer the swing producer. I mean, they have large excess capacity in space, but there are so many, the non-OPEC production is so large that they were just losing market share. Why? So maybe that's part of the rationale. But the point is that these have been events in the last half of last year, particularly in November, which seem to have moved the oil market quite sharply. And what does this mean? So, I'll show you a couple of pictures about, putting in oil prices, the oil price outlook, and to find standard macro models and what that might mean. But I just want to show you a little bit about this picture. This is a complicated picture, and I'm afraid it may not be all that easy to see. But what this picture is basically showing you is the so-called global cost curve for oil. So what you've got out here at the bottom is, I can't even read it actually. Right. This is production. And these are prices. So what this shows you here is that this is a chunk of supply that comes from the easy to extract stuff. This is Saudi Arabia. It's very low cost oil. It's very cheap. I mean, actually the average cost is there, but the Saudi cost I'm told is like the break even something like $7 a barrel actually. It's really down there. Well, there's a whole bunch of others as well, but the interesting one is, God, I can't even look it out. Sorry, this is really hard to read. Shale is there somewhere, right? Where is shale? Is there? No. I need new glasses here. There we go. So you can see here, I mean, the basic point is that a lot of production has come on. The size of these boxes are telling you the amount of production that is actually taking place. The point out here is this, that at current levels of prices, there's a pretty significant chunk of global supply that is not a break-even. And I think this is something you